Today we're looking at Nvidia Corp as an investment. I'm going to be analyzing this company, taking a look at all of the fundamentals, and last but not least, making a price target so you can see what you should be paying for Nvidia based on the assumptions that I put into a stock analyzer tool. Let's just jump right into this and look at some metrics on Nvidia so we get kind of a hang of the basics. So first of all, I want to look at the stock price here. You can see it went from $314, almost like the price has almost been cut in half, now at $168. So the market cap has fallen drastically to 418 billion. They have a relatively low revenue compared to that of 24 billion. Net income of 8 billion. That means that is a price to earnings of 50, a 5-year price to earnings of 86, and a price to sales of 17. The profit margin has been growing here the past year because of the shortage, so we have to keep that in mind when we go ahead and make our assumptions about the future. But they do bring in 8 billion in cash flow the past year, and over the past 5 years that has been an average 4 billion. So something that I'm already kind of concerns me with this one is the fact that they bring in 8 billion in cash flow last year, and that was a great year for them. So they bring in 8 billion, and the market cap is almost half a trillion. Something isn't quite right here, and the reason for this is there's a lot of growth expected for Nvidia, and that is what you're paying for with a 50 price to earnings ratio. Although the stock price has dropped, it still looks kind of expensive. But a thing that is good to see here is the fact that we have a high 5-year return on invested capital. That is, what returns are they generating on the money that you invest into the business that are invested through debt or equity. So when you invest or when they take on debt, they can generate a 13.4% return on that. So let's see here in the income statement if they're growing their revenue. They went from $7 billion to $26 billion over the past 5 years. That is incredible growth, guys. Let's see here for the net income if they're growing their profitability, also growing massively there. We want to see their shares outstanding decreasing or staying the same. We don't want to be diluted as shareholders. And you can see here we went from having 2.4 billion shares to now having 2.5 billion shares. They have been diluting a little bit. We'll see how bad that it is in a moment. So they are growing massively, but they are diluting a bit. That is 1x there. See here, they can pay off the entire, with the 21 billion in cash on hand, they can pay out of the entire total liabilities with the cash that they have on hand. So financially, they are in a great position. That is great to see. Their cash flow, we want to see that being positive and growing. We can see here it went from 3 billion to 8 billion. And yeah, the capital expenditures right here has also gone up with it. So what we do to get a starting market cap for a company usually is that we take the average 5-year free cash flow and we multiply that by 20. Yeah, they should be worth around 100 billion for the starting market cap. And then there's other factors that play in. So that doesn't automatically mean that this is an overvalued company, but that is 4x what we would like to see here. So that is definitely, that would require some good growth or share buybacks or something to make up for that. So let's head in here to the 8 pillars so we can see what is up and down. So basically everything that we just looked at is taken out for us right here. We can see that they are good at generating return on the invested capital. They are growing their revenue massively. Net income is growing massively. Shares outstanding, they're diluting a bit. But in financially, with their long-term liabilities divided by their 5-year free cash flow, that also looks sustainable, and their cash flow is also growing. So the only 3 X's we have here is the value indicators here. This one and this one has to do with the price to earnings ratio and the price to free cash flow ratio. And their shares outstanding is going up by 12% the past 5 years. So yeah, some X's here. So the fact that we see these ones red can be kind of a concern because that is the value indicators. But there are things that make up for higher price to earnings ratios, and that is why we use this stock analyzer tool. And for that, we want to go into Simply Wall Street here and see what they're saying. So we have some, I actually want to head straight to the future growth, because that is what I'm interested in, seeing how can they grow their earnings and their revenue, most importantly. 15% annually is what they are saying here. Analysts, I don't know how many analysts is this, that is 42 analysts make this statement. So I believe in this one, 15% for the earnings growth. I would expect that would be somewhat of the same for the maybe a little bit higher for the revenue. So now we can go ahead and go into the stock analyzer tool and take a look at it here. So they are projecting 15% earnings growth. This is the revenue growth, and let's say it's a little bit higher than that. Let's go 50. Now I'm going really high, because this is a $500 billion business. But the reason that I put in high growth for the revenue is because I know that this revenue is very tiny. You know, they're almost making no revenue, so they can grow that pretty substantially, factoring in that their multiples contract a large bit. And let's put in some really high numbers here. I did this before, and then we have 25. Let's say that they do a little bit worse than their average 10 years, but for the mid we want to say 30 and then 35. And I don't think we're going to hit 35 because there's massive competition coming up, and they have, you know, had this great boom in the last year. So maybe that is actually way too high. But then again, 25 is probably also to the low side. So yeah, let's put this in, and for the price to earnings ratio, I'm going to have to put in a little bit higher, because look at this growth here. That is amazing growth. So that maybe demands a little bit of a higher price to earnings. I put in 12.5% here, because that is the desired annualized return that I want. Essentially what is going to happen here is we are going to get prices that we should be buying at if we want this return that I've demanded. And the reason that I put in 12.5% is because I could get 9 or 10% in an ETF, and that is a lot less risk you're taking on when you're diversifying yourself like that. So hit the analyze button, come down here, you can see, okay, so if they hit these assumptions, they're actually massively undervalued at the moment. They are like a 2x. They're worth what they were at their peak, right? But at the mid, if they do 20, this is for the next 10 years, guys. If they do 20% every year for the next 20 years, that is higher than analyst expectations for their earnings growth. So already they're going above analysts. Also, you know, kind of also taking into account that they return to post-pandemic margins, and then they have a 18 price to earnings. Then we're laying at, you know, actually not too far from where we're at the moment. But what I think is possible for this company is what I'm going to do right here in the low. I think they can go back to post-pandemic margins, and then they can trade at like a whatever 17 in 10 years. This is in 10 years, guys. So I'm willing to pay $100 a share for this one. And that is the hard truth about Nvidia. So at the moment, I still think this company is overvalued, but I do think that we could very easily, very fast, go down hill for this company if we get into a recession. These overpriced companies tend to fall the most. So I definitely want to go ahead and set a price target for this one at around 150, so I can start looking out for it. Going to notify me right there. So with that said, I hope you have a great rest of your day. Peace out.